Hello everyone. As some of you might be aware, or maybe not, um, SOFR is going to be replacing LIBOR very soon, starting 2022. And that's why I wanted to make a video on LIBOR and SOFR, explaining what's going on, why it's going on, and what may happen going into future. So let's go into this article. This is what is LIBOR and why it is being replaced. So this is from Miranda Marquardt and Benjamin Curry. So almost for 40 years, London Interbank Offered Rate, that's what LIBOR stands for, was the key benchmark for setting interest rates charged on adjustable loans, mortgages, and corporate debt. So it's a benchmark that is used to set interest rates on, financial instruments, whether it's mortgages or personal loans, car loans, you name it. So over the last decade, LIBOR has been burdened by scandals and crises. Effective December 31, 2021, LIBOR will no longer be used to issue new loans in the United States, and it'll be replaced with SOFR. So SOFR is also a benchmark interest rate, which is replacing LIBOR. Uh, uh, and as it sounds from what these guys are saying, LIBOR had a lot of scandals, and it's not a reliable benchmark, and they want to replace it with something, more reliable that people had more faith in. Um, let's see how much of it is reliable. So LIBOR provided loan issuers with a benchmark for setting interest rates on financial products. It was set each day by collecting estimates from up to 18 global banks on the interest rate that they would charge for different loan maturities given their outlook on local economic conditions. So this is really important how this really works, LIBOR works. So they ask 18 global banks, tell us what interest you will charge if you have to lend some money to your peer bank over a timeline. So it can be of 1 month maturity loan, it could be 3 months, 6 months, 12 months, or just simply overnight. So all these this is called basically term structure, uh, and they provide their interest rate they will offer on a loan depending on what they assess as risk. Um, and it is not limited to just United States dollar. It is calculated in 5 currencies: pound sterling, Swiss franc, euro, Japanese yen, and US dollar. So these interest rates, so these 18 banks provide their interest rates for all these 5 currencies over different loan maturities. And what formula they use once all these 18 banks provide these numbers, that may I to be honest, I don't know. I think it is an average, and we may find out later in this article. But it could be anything. It could be just simply whatever 18 banks are providing, let's average them. That's the final interest rate. Or it could be let's pick a median. So if 18 banks are providing it, let's pick a median. So median would be in whatever is the middle number. Um, if it is not average or median, it could be, hey, let's pick the bottom three, let's pick top three and average those. It could be any of those formulas, but let's see, go through the article further. London interbank offered rate was used to price adjustable rate mortgages, asset-backed securities, municipal bonds, credit default swap, private student loans, and other type of debt. As of 2019, 1.2 trillion worth of residential mortgage loans and 1.3 trillion consumer loans had been priced using LIBOR. That's a lot of debt that is priced through LIBOR. When you applied for a loan based on LIBOR, a financial firm would take a LIBOR rate and then tack on an additional percentage. So whatever that benchmark LIBOR rate is, let's say XYZ bank, let's say Bank of America, I can a LIBOR rate is say 0.5%. So in other words, I can get that money from my peer bank at 0.5, and then on top of it, I will slap my risk to you as a customer, and that would be the final rate to you. Here is how it works. For a private student loan based on LIBOR 3-month rate plus 2%. So if the LIBOR 3-month rate is this much, and they will slap another 2% on it, so final would be this. While no longer while LIBOR will no longer be used to price new loans starting in 2022, it will formally stick around until at least 2023. 1 week, 2 months, LIBOR will cease being published at end of 2021. So short-term LIBOR will no longer be available, while overnight, 1 month, 3 month, 6 month, and 12-month maturity will continue to be published through June 2023. So at least for another year and a half, this term structure or the maturity curve will be there. When an adjustable rate loan, your lender sets regular periods where it makes changes to your rate. You being charged the lender reference LIBOR when adjusted the interest rate on your loan, changing how much you pay each month. So basically, what this is just simply explaining that if you are if you have if the term structure for the LIBOR is up to maximum 12 months, and let's say LIBOR is being used to create a adjustable rate mortgage for as home price or asset back or MBS, mortgage-based security, then how does that work? So basically, that's what they are explaining here, that it is adjustable. So, whatever is after that 12-month maturity, that will change your adjustable mortgages based on, whatever the contract is. If it is 3 months, then it keeps on changing every 3 months, and so on and so forth. How is LIBOR calculated? Each day, 18 international banks submit their ideas of the rates they think they would pay if they had to borrow from another bank on the interbank lending market in London. To help guard against extreme highs or lows that might skew the calculation. ICE, which is Intercontinental Exchange Benchmark Administration, strips out the 4 highest submissions and 4 lowest submissions before calculating an average. There you have it. So that's the formula I was talking about earlier. It's not the average of 18. It's not picking bottom 3 and top 3 and averaging them, not the median. It's actually stripping out the bottom 4 and the top 4 and pick the middle 10 and average those 10, and that's your final number. Okay. It's important to note that LIBOR isn't set on what banks actually pay to borrow funds from each other. Now, this is also a very important point. LIBOR isn't what actually pay to borrow funds from each other. It's actually what they submit. This is very important. So the number they are submitting for LIBOR calculation may be different from what actually they feel that I will lend money on. So I am Bank of America. For some reason, there is a potential I can manipulate the LIBOR rates by giving either higher or lower numbers for LIBOR calculation. And in my mind, I am prepared to lend at a different rate. And this is exactly the point what actually led to these scandals and fraud in LIBOR rates during GFC. So instead, it is based on the submissions related to what they think they would pay. As a result, it's possible for bank to submit lower rates and manipulate LIBOR fairly easily. In the past, panel of bankers oversaw LIBOR in each currency, but scandal exposing manipulation of LIBOR has led many national regulators to identify alternatives to LIBOR. And this is exactly what happened in 2008. So the use and abuse of credit default swap was one of the major drivers of 2008 financial crisis. A very wide range of interrelated financial companies insured uh, risky mortgages and other questionable financial products using CDS. Rates for CDS were set using LIBOR, and these derivative instruments were used to insure against defaults on subprime mortgages. Now, this is very important. So, this is exactly what I was talking about earlier. Now, if I hold some CDSs and default of those CDSs happens at XYZ rate, interest rate. Once interest rates hits this much, then my CDSs are going to default. What am I as a bank going to do? I would try to keep that to make sure that interest rate never hits that value, whether on lower side or on higher side. So if that interest rate has to for my default has to increase, then my submissions would be on the lower side. If that interest rate for the CDS default are on the or are to be hit when the interest rate goes lower, then my submission of the LIBOR rate would be on the higher side. So that's how these things were manipulated during the GFC. AIG was the biggest player in CDS disaster. The firm issued vast quantity of CDS on subprime mortgages and countless other financial products like mortgage-based security. The crash of the real estate market in 2007, followed by even larger market meltdown in 2000, forced AIG into bankruptcy, resulting in one of the largest government bailouts. Yeah, this is once AIG started falling apart, it became clear that subprime mortgages and the securities built on top of them weren't properly insured. Many banks became reluctant to lend to each other. LIBOR transmitted the crisis far and wide, since every day LIBOR rate setting banks estimated higher and higher interest rates. LIBOR rose, making loans more expensive, even as global central banks rushed to slash interest rates. So LIBOR rose because they felt that this is dog subprime, these subprime mortgages are dog crap. So, but the global banks were reducing the interest rates. I mean, it was a kind of a manipulation. With rates on trillions of dollars of financial products soaring day after day, and fears about stunted bank lending reducing the flow of money through the economy, markets crashed. LIBOR was one of the many factors that created the financial industry disaster of 2008, but its key role in transmitting the crisis to all parts of global economy has driven many nations to seek safer alternatives. So this talks about LIBOR in a manipulation by different banks, Barclays, Deutsche, Rabo, UBS, Royal Bank of Scotland. Barclays was a key player. They would submit its LIBOR estimates claiming that it was lower than what other banks will actually charge it. Not just Barclays, UBS was involved in LIBOR setting as well. This was the guy. So now SOFR is replacing LIBOR in the US. Now this is another point to remember. SOFR is for US dollar only, whereas LIBOR, as I explained up above, is used for calculating 5 different currencies over various maturity terms. Not only these scandals that undercut LIBOR, according to ICE, banks have been charging the way they transact business, and as a result, LIBOR rate becomes a less reliable benchmark. SOFR will be the main replacement for LIBOR in the United States. This benchmark is based on the rates US financial institutions pay each other for overnight loans. So instead of the banks submitting the number, the SOFR calculation is based on what they actually pay over for the overnight loans. These transactions take the form of treasury bond repurchase agreements, otherwise known as repo agreements. They allow banks to meet liquidity and reserve requirements using treasury as collateral. SOFR comprises the weighted averages of rates charged in these repo transactions. Why weighted average? I don't understand that. Why do you have to weight them? Does the transaction done by BOA has more weight than the transaction done by uh, JP Morgan? I don't understand that. Why would it be? It's talking about all treasury bond repurchase agreements only. So there is no other collateral. Treasuries is the collateral. Why weighted average? Yeah, I don't get that. They should be all treated same. Interesting. I might have to understand that better. Going on, how does this impact your loans? Even if LIBOR doesn't completely disappear as soon as expected, there is a good chance banks and other lenders will start looking for other ways to determine market rates. If you have an adjustable rate loan, check to see if it is based on LIBOR. For loans based on LIBOR, find out what index your lender will be switching to. While there might not be a set answer now, keep an eye on the situation. A switch to a different index means a higher base rate in the future. So according to this guy, it will be higher. Logically speaking, yes, it should be higher because the risk are higher, and the interest rates are extremely low. They should be higher, a lot higher. Um, even being manipulated by Federal Reserve, they should be a lot higher. So yeah, that's LIBOR and so forth. Now, term structure. There are a lot of talks about term structure that is missing in case of SOFR, and even I myself have some questions around that, because while the SOFR, according to this article, is a weighted average of overnight lending rate, how do you extrapolate that over a longer maturity term? So for 1 month, 1 week, 6 months, 1 year. How do you extrapolate that? Unless they provide, you go back to the similar sort of uh, approach as LIBOR was doing, that you ask them, hey, what do you feel it will be over 6 months? What do you feel it'll be over 12 months? You submit your numbers. We run that through a formula. So pick middle 10 and then average them, and that's what it is over longer period, whatever. Um, yeah, I do need to figure that out. But anyway, so what is the term structure? Essentially, term structure of interest rates is a relationship between interest rates or bond yields and different terms of maturities. When graphed, the term structure of interest rate is known as yield curve. So there you have it. So it's just simply an yield curve, how the interest rates are behaving over longer maturity. So starting with today's week, month, 3 months, 6 months, 12 months. This is an example of LIBOR scandal. An individual homeowner may have initiated fixed rate mortgage at a time when mortgage rates were artificially lifted based on an upward manipulation of LIBOR. So yeah, so if you are getting an interest rate, fixed rate mortgage, and LIBOR is manipulated to higher side, then you are stuck paying that higher interest rate for the rest of your life. SOFR. So according to this, SOFR does have a term structure, and it's 1 month, 3 months, and 6 months tenors. And when I did a more Googling on that, it says in April, CME, which is Chicago Mercantile Exchange, announced a launch of a term structure for SOFR 1, 3, and 6 months tenors. And basically what they are saying is it is CME certified that its rate is aligned with the IOSCO principles for financial benchmarks. I guess these principles are that, hey, we are not manipulating these numbers or blah blah blah. I'm not sure, but there is definitely a term structure. It sounds like for SOFR. This is from Federal Reserve itself. So this is overnight SOFR rate, and it is extremely low. This is like 0.05 as of December 27th. It's almost zero. It spiked insanely, so about 5-6% um, in 2019, September 12th. So this is just before that repo crisis in October. It spiked insanely. So it means that short-term lending was extremely expensive. Nobody was trusting each other with the money. So you will have to pay exorbitant rates or interest rates to lend each other. This is the 30-day average SOFR. Again, it's very, very low. This is the only bit that I'm confused. Why these are so low? 30-day average SOFR. This is the 3 months, extremely low. This is the 180 days. This is 6-month one, and it is the 6-month one 0.049. This is also 0.049. So they're both almost same. This is 3-month LIBOR. Uh, And for some reason, as you can see here, there is a spike down because of the prevailing sickness. It's not visible in these averaged out SOFR rates. And LIBOR is 0.216 as of December 21st, which is just about 15 or 16 basis point over the SOFR 3 months average. So for financial volume, it's I shouldn't say extremely, but it's very high. It's about $888 billion, so near about $1 trillion average per day. I couldn't find out any overnight financing volume with LIBOR in US dollars. Need to find that. Anyway, so that's on LIBOR and SOFR. I will keep an eye and try to figure this out more, how this will impact the mortgage rates going forward, and I'll probably post another video on that. Please, if you have any questions, put them in the comments. I will try to answer them. Thanks for listening. If you have anything to share, please post those in the comments as well. And I will see you next time. Bye.